Hey, what's up YouTube? In this video, we got Target to go over, ticker symbol TGT, and they reported their Q3 24 numbers on November 15th, beat on top and bottom lines, gave a little bit of guidance, and with that guidance, majority of analysts have revised their next quarter expectations higher, and a few of them had revised their expectations a little bit lower. So on Target right now, we're looking at a forward PE of about 16.5. We have a dividend yield of 3%. Short interest is sitting at 1.7% with a market cap of $63.8 billion. So in their report from their earnings, they gave, I think, two key highlighted points here that I took away from it anyway. Is the first one here is we see they claim that they generated more than $5.3 billion of operating cash flow compared to last year at $550 million in 2022. So when we take a peek at that real quick, once we hop over to their 10Q that they released to us, we come over here to their cash flow statement. We can see right here, $5.3 billion in cash from operating activities and $552 million last year. So when we dissect that a little bit here, we can see the big hit to their overall cash flows is from their inventories. And obviously, 2022, there's a significant supply chain constraints. So companies were typically over ordering to try and get as much inventories as they could. So that way they could keep their shelves full and keep revenues coming in. So obviously, inventories took a big hit to their overall cash flows. So really, in my opinion, that statement is kind of deceiving because their cash flows, yes, they are better year over year, but now they're getting back in line with where they had been prior to 2022. So once we get through more of the financials, you'll see that statement really is just saying, hey, we're back to where we used to be. They're not technically better, but they are better than last year. So I found that one to be, if that's the best they can come up with, it was just one of those statements that was like, you dissect it a little bit and you're like, oh, it's not really that great. And then you come down here to guidance. This is really only guidance they really gave us. And they're just saying that next quarter, they're expecting mid to single digit declines basically year over year. So even including Black Friday sales and all the holidays going on, they're still expecting declines in their overall revenue. So I don't see these, overall, I didn't see the statement as too much of a positive, but once you get through the financials are starting to come back in check to where they used to be. So that is very good. Also, one thing I wanted to note is with Walmart's guidance that they gave, they're giving fiscal year 24 guidance, so a full year's worth. They're expecting 5 to 5.5% revenue growth. So maybe some of Target's increase in share price recently is because of Walmart's guidance for revenue growth. So obviously next quarter, Target's not expecting any revenue growth, but maybe for the whole year, they're potentially going to see 5 to 5.5% growth as well. So that's a little bit of some speculation. Obviously, they didn't give us any guidance for full year, but they did give us guidance for next quarter. And next quarter not looking too good, but I would assume some of that euphoria piling into Target is from Walmart's guidance. So we hop over to their 10Q onto their income statement, and we can see we're on the 3 months end here. They just produced $25 billion in revenue compared to last year, only at $26 billion in revenue. However, we come down here, operating income, we went from $1 billion to $1.3 billion on less revenue. So that we can, obviously that's a big increase in margins. So that's very good to see. And then we come down here to our net earnings. We did it. We generated more net earnings than we did last year on less revenue. So that means margins are getting back to where they used to be. So that is very good to see. So we then come down to our balance sheet here. We got this. This is one of the things I really dislike about retail companies is most of them, their balance sheets, in my opinion, just are not great. The Target's got $1.9 billion in cash, and it's a $64 billion market cap on the company. And then on top of it, you add up all of their total liabilities they have. They got $43.7 billion in total liabilities with only $1.9 billion in cash. And even if you strip out their accounts payable, you're still sitting at about $29 billion of total liabilities, and then you still only have $1.9 billion in cash. So you're still negative $27 billion overall on your balance sheet. No matter which way you shake it, it's still not, in my opinion, not a very good balance sheet on most retail businesses anyway. It's not just Target, it's Walmart and others out there as well, like Dollar General. But company does have retained earnings of $6.2 billion, which they can use for paying dividends or doing something within the business to help it grow as well. So we got net earnings here of $2.7 billion. We get to add in depreciation. Here's our inventories. Inventories grew on our asset side, so then that's a negative to our cash flows. So we strip out $1.2 billion. Still left with a positive $5.3 billion cash provided by operating activities. We already kind of went over that. We subtract out our capital expenditures of $3.9 billion. It leaves us with $1.4 billion in free cash flow in the last 9 months. But then we come down here a little bit. With all of our financial activities that the company does, which is a very normal quarter, we can see a little bit of reduction in long-term debt. We paid out dividends, and we also had a little bit of taxes on share-based compensation as well. So with that, we take our $1.4 billion that we have of free cash flow, minus off $1.7 billion here. That leaves us with negative $319 million. So we used to have this, beginning of this period, we had $2.2 billion in cash and cash equivalents. But we burned through $319 million, so now we're still seeing a reduction in our overall cash position. So I think this is something to keep a close eye on as well. Even with positive free cash flows and everything else, we still want to see our cash position grow, because if they can't continue to grow their cash position, they need to raise more capital somewhere, or something's got to change within the business, and that could lead to a potential dividend risk as well. So just something to keep an eye on if you are a dividend investor on this business as well. So over to the financial valuation spreadsheet that we have. We got financials, comps, calculator, several calculators all the way over into our final valuation here. And if you want access to this spreadsheet, it is available on patreon.com. Link is in the description below. So on the financials here, we're going to come over here to our charts and see how this company is trending. And we know in 2022, 2023 timeframe, actually 2023 because of their fiscal year, how they count their calendar years, was pretty tough on the business. We can see their margins and everything else, their free cash flows, everything within the business just took a big hit. But we can see it looks like things are starting to turn around. We've got our trailing 12 months on the right-hand side where our net income is starting to trend back higher. We can see in our last quarter results, we saw 28.5% gross margin, so we're 1% away from where we typically run. And on our net margin, same thing. We're about 1% away from where we typically run on this business for net margins as well. So it looks like our margins are getting back. So that's fantastic to see. We got our return on invested capital. Historically, we're sitting about 14-15% range, right? So we're starting to get back into that range as well. Very good. PE ratio, historically, we're kind of in the higher range of historical price to earnings on this business right now. So it's really all going to come down to earnings. So, currently trading based on PE and based on historical PE, we're trading at about a fair valuation based on historic PE ratios. And come over here to net income, free cash flow. As we can see, last year, big hit to free cash flows, but appears as though they're getting that back. And we can see our free cash flows, again, like I said before, looking like we're kind of right back to where we used to be, sitting at about a $4 to $5 billion free cash flow average. Obviously, some higher, some lower, but it seems to be about a $4 billion average roughly on free cash flow. So we're basically right back to where we used to be, so that's good. Capital expenditures, though. Capital expenditures have increased significantly in the last couple of years here. Went from $3.5 billion all the way up to like $5 billion. So we increased about $1.6 billion on CapEx. So maybe another thing to keep a close eye on. Maybe these will start to reduce a little bit as well going forward, but we'll have to keep an eye on that as well. That's going to impact our overall cash flows also. Share count dilution. As we come up to here, we can see common stock repurchased. We're not seeing that really. Common stock issued, not seeing any of that, but they are still handing out stock-based compensation, but a pretty nominal amount. So you're not really going to see too much of dilution in the share count. As a dividend investor, you do like to see dividend growth, and you are seeing dividend growth within this company right now. As long as they can continue to grow their overall cash flows and able to pay out for those dividends, then this will be just fine, and they should be able to continue to likely grow this in the future, but it's going to take a little bit of work, I think, for the company to do so. Over to the comps, we have two other companies to compare it to. We have Costco and Walmart. And we come down here to our comps on margins. We did do, in our last video, we did do a valuation on Costco, so check that out. I'll drop a link to that right now in the right-hand corner. So we come down here to margins. One thing in the Costco video that I wanted to mention is we can see our market cap to revenue on Costco. We have a higher market cap than revenue, but on Walmart and Target, it is the opposite. We have a lower market cap than revenue on both businesses there. So could indicate that Costco is potentially even more overvalued than we thought. Gross margins sitting at 26.7%, so pretty decent margins. It's right in the middle of the pack there. We got operating margins as the best and profit margins also as the best on the board. So pretty good margins on target. Free cash flow, we can see the lowest free cash flow on the group here. So they could do a lot better on free cash flows in comparison, especially with better margins. They should be able to produce better free cash flow as Costco and Walmart. So they got, I think, some work to do there. Return on invested capital, pretty good. They have historically done better, so we could see this get a little bit better than where it is right now. So that'll be good to see. And a PE for the business, we can see we're the cheapest for sure on the group, but we're also not the best business, probably not the best ran business of the group either. Costco definitely is very well ran. Walmart is also very well ran. And Target, not the greatest, but still a pretty good business. Over to the valuation spreadsheet now. So what we'll do is we're gonna run today's EPS and today's PE, and then we'll come back after we get our valuation on today's numbers and plug in forward-looking numbers as well and figure out what forward-looking numbers are gonna be for evaluation on this business as well. But today we're looking at P/E fair value of $119.44. Multiples comparison, $281.11. And it'll take about 12 years for this company to earn its current market cap. Price to book, historically 6.2, today 5.09. We have a PEG ratio of ridiculous because we only have a growth rate of 0.67 on revenue growth there. Graham's valuation gives them $254.24, a dividend discount model of $140.70. Our DCF on the business. So analysts have a growth rate of negative 12%. Historically, they've done negative 65% growth. Obviously, we've looked at their capital expenditures. We can see we're pretty close to where they have been historically on free cash flows. So I'm going to just give them a 0% free cash flow growth rate, and that gives them $93.72. And down to Rule 72, we have three sources of an EPS growth rate for an EPS growth of 6%, which is pretty good for retail business. And then we get to double our current EPS about one time, and we're sitting at 7.85 and shy of one time. I give them about a 14 for future EPS, which is a fair value of $42.43. So to our fair market value on the business, currently trading just shy of $138 per share. Our fair market value today is $155.26, 30% margin of safety, about $109. And analysts have a price target of $150.69 on this business. So again, what we're gonna do is circle back here, and we're gonna plug in forward-looking numbers, which we can pull in from Seeking Alpha, which we got 8 and 16.5 for our numbers. So we can plug on 8 and 16.5, and these really aren't gonna change our valuations too much here. So our P/E fair value is sitting at $121.72 now. Multiples, 286.40. Graham's valuation, 259.11. Dividend discount model will not change. Free cash flow won't change. Rule 72, we can probably bump up to like 16, maybe 15. We'll give it 15 there. Gives them $45.46. So then that gives us, including the forward-looking 12 months, assuming everything comes up within expectations, we're looking at about a fair market value of $157.85, and 30% margin of safety then becomes $110.50. So not much of a change there, even including the forward-looking 12 months forecasted for this business. So over to the stock chart, we have three major trend lines drawn in here on Target, and we can see we're on the weekly chart as well. We can see on this really big green candle with a lot of volume, that was earnings. So earnings pushed this thing into trend line, into the downward trend line, broke through, is back testing the upward trend line. Probably what's going to happen, looks like we're failing here. We'll likely pull back. Depending on how we pull back, we could pull back into this range where we're going to do a convergence of trend lines. And then right here, probably a pretty solid buying opportunity since we have broken trend, our downward trend line. Even if we back test it, it still shows that we could be making higher lows, which would be very solid to see. If we pull back, consolidate, and potentially see some upward movement here, retest this trend line, potentially even break through and get back up to the 150 to 170 range, price range on this business right now. And obviously, as things progress within the economy, we should see this continue to find its way back up higher and maybe get back within trend, get back above this blue line and can resume its higher highs and higher lows within its overall historical trend line there. But that is it for Target. Found value in this video, drop a like, subscribe, and comment. And back later with another stock analysis video. Also, check out Costco. This thing just keeps going. I bet this thing's going up to $700+ per share before we see a pullback in it. It's just got that big $15 dividend payout that I think a lot of people are, nobody's going to sell until after they get that payout. So I think this thing is just going to come crashing down once that payout comes. But we'll have to wait and see if that happens or not.